Choose the false statement about hedge funds. So we're looking for something that is incorrect. While traditional fund managers charge mainly a management fee, hedge fund managers charge both a management fee and a performance-based incentive fee. That is a true statement, so it cannot be correct because we're looking for false. Redemption of funds from a hedge fund prior to its liquidation is very hard due to the initial lockup period and specific terms of redemption. Well, that is true as well. So we got to get rid of that. So we got to take C. Individual retail investors cannot invest in hedge funds and only institutional investors can. And that is not true because all you need to be is an accredited investor. An individual can be an accredited investor. For example, I'm an individual investor. I'm a retail investor, but I'm accredited. I do have hedge fund investments. Answer here is C. A fundamental long-short hedge fund manager is evaluating specific securities to build a portfolio's position. Which of the following is the strategy the manager would least likely adopt? Long securities that have upside potential relative to current price. Well, we're fundamental long-short, so yeah, you'd do that. Short sectors with macro trends negatively impacting the company. Yeah, because you need short positions as well. You'd do that. We got to take C. Long securities that trade at a significant discount, and you'd be saying, so far, so good, expecting an increased valuation in case of a bankruptcy. So this is looking for a particular event. So this would be event-driven, or it may even be deep value, but it is not fundamental long-short. Let's get rid of C. Well, sorry, we'll get rid of C, meaning C is our answer because we're looking for least likely. Which of the following fund structures is most likely to be suitable for an institutional hedge fund investor that seeks highly customizable offering with negotiable fees? So we need some flexibility here. We have 4 options. We usually just see 3. I think we can get rid of mutual funds right away because we're looking for a hedge fund. We can get rid of mutual funds. You can probably get rid of fund of funds because we're looking for something customizable. It is doubtful that you'll get a fund of funds level. You have to go and speak to a GP at a hedge fund. We have separately managed hedge funds and commingled hedge funds. If we're looking for something customizable and negotiable fees, of the 2, which one do you think is more likely? Separately managed, right? There we go. Which of the following parties is responsible for the portfolio management of a fund of hedge funds? Well, the primary responsibility for anything within a partnership structure is always the general partner. So here we are with B. You can eliminate A and C by recognizing that an accredited investor would become a limited partner. Those are the same 2 things, and since there can only be one answer, you cannot take A without rationally saying, but C is the same thing. So you must eliminate both A and C. Which of the following best explains why it is unlikely a poor-performing hedge fund would be added to an index? We have survivorship bias, backfill bias, and selection. Well, we can get rid of backfill bias because this is when a hedge fund is added to an index, its past performance is backfilled. We're looking for why it is unlikely it would be added to an index. Survivorship bias deals with exit from an index, so we can get rid of that. It is selection bias. The hedge fund manager, selects not to report to any particular index. The strategy that identifies opportunity for future merger, bankruptcy, or spin-offs and seeks to profit from pricing inefficiencies is known as, well, these are events, right? We're looking to trade on specific events, so that is event-driven. A money manager was reviewing the automobile sector and identified the stock of General Motors is relatively overvalued compared to Ford. Money manager purchases 100 shares of Ford, shorts 150 shares of GM. Turned out the manager's perception was right. At the end of the quarter, she unwinds both positions, making a profit on both. What is this strategy called? Well, we are long and we are short. So it is equity long-short. And since there cannot be 2 right answers, it is A. We do know that we have a long position and a short position. Hard to argue that it's not. It's not event-driven because there is no specific event going on. You might say, well, relatively overvalued, I see relative value. Maybe it's relative value. But the difference here is you have General Motors versus Ford. Now, if you had something in General Motors, such as a particular bond, let's say, or a preferred share, versus the equity, and there was some relative valuation difference between them, there's relative value. But this is between two different companies, a long and a short position. It is equity long short.